Hello and welcome to Securities Lending Weekends. I'm Roy Zimmerhansl and I'm your host. In this video, I'm going to be reviewing the first half of 2022 for securities lending and giving my thoughts on the outlook for the second half of the year. So, if securities lending is your thing, if you're a lender, a borrower, a vendor, an advisor, or just plain interested, then this is the place for you. So let's get started. Hello everyone and welcome to another episode in the fundamentals of securities lending. Now some of you will be expecting this video to be about GameStop, which I've been promising for a couple of weeks at least. However, I thought I'd wait for two reasons. First of all, the 4-for-1 stock split just happened this past Friday. So I think from that perspective, I'm going to let things just kind of settle down a bit and see how markets and investors react. Second, the more I dig into this, the more layers I find, so I don't want to rush things. It may be, in fact, that I do more than one video looking at a few different angles, so stay tuned. Today, I'm going to be focusing on the first half of the year in 2022, both for the markets themselves and for securities lending. Then I'm going to share with you some of the thoughts and my thinking on what people are looking for from the markets in the second half, and what I think that will mean for securities lending revenues for the rest of the year. Before I carry on, don't forget to give me a thumbs up if you find this video or the other videos valuable, and subscribe to my channel if you haven't done it already. Now, if you ring the bell, you'll be notified every time I post a new video. Also, remember that I'm not a financial advisor. I have no qualifications. This isn't financial advice of any kind. Always do your own research. Speak to professionals before making any decisions. Now, the first half of 2022 has seen market volatility, the Ukraine war, and the shift of transitory inflation to inflation rates that are higher than government officials and many leading economists predicted. Their explanation is the series of supply shocks which challenge the models that economists use. So, demand shocks from COVID, supply chain recovery problems, energy and war in the Ukraine, and the labor force reduction shock experienced in many countries. And all of these things happened with real no space in between. They just carried on. Fed Chairman Powell recently described it as, "I think we understand better how little we understand about inflation." Wow. So how did the markets perform? Well, dismal is a word that springs to mind. For equities, the MSCI World Price Index and the S&P were both down 20%. And that's the worst performance for the first half of the S&P since 1970. Like the NASDAQ was down roughly 30% as the tech sector has been hit harder than others. And that same tech sell-off affected both Taiwan and Korea, both important sectors from a securities lending revenues perspective. The D-SPAC index, which tracks 25 of the largest listed companies that went public as a result of a SPAC, was down 67% in the first half. And with falling equity markets, we saw another 30 SPAC transactions canceled and even had 8 sponsors shutting down and returning money to investors. Global IPOs were down 46% over the same period in 2021 by number and 58% down by value. And the overwhelming majority of 2021 IPOs are trading below their offer price. Global M&A was down 20% compared to the first half of 2021, but look, that's up 35% compared to the same period in 2015 to 2019. Following the US and China, India was very active in the M&A space, but of course, because of restrictions on the securities lending market, or short selling really, in India, it doesn't really impact our business. Bonds haven't fared any better, with the US and Eurozone government bonds down 11% and 13% respectively in the 7 to 10 year space, and investment grade bonds down 14% in the US and 12.5% in Europe. Many commodities are also down, with the exception of energy and food-related companies, both tied to the Ukraine war. Even Bitcoin was down circa sort of 60%. So I think you have to agree with me, it was a pretty tough 6 months for markets. But how did securities lending fare? Both DataLend and S&P IHS Market reported first half lending revenues from market participants in excess of $6 billion. And DataLend shows that as being up 6% year on year. Now that was driven largely by a 22% rise in fixed income lending revenues due to both increases in both balances and fees. Equities were a little bit more modest with a growth figure of 2% year on year. But of course, equities have a much bigger volume, so the revenues there actually reached $3.7 billion, led by growth and balances in both Asia and in Europe. S3 Partners in a recent report advised that both healthcare and financials had larger than average increases in short interest, and that SPACs and communications had larger, communication services, I should say, had larger decreases, and presumably that was as investors were booking profits in the latter two sectors. Now, despite the revenues generated by bonds and the growth in Asia and Europe, DataLend identified GameStop, Lucid, Dutch Brothers, Upstart Holdings, and Beyond Meat as the top 5 fee earners for the month of June, and none of those names should really surprise anyone. Now, cumulatively, those 5 alone accounted for $115 million of the $897 million generated in the month of June, and that's about 13% of total lender revenues. So, in summary, I guess my view is that's a pretty strong first half, but hardly surprising given the backdrop of market conditions. In fact, for me, if there's any one question, I'd almost ask why revenues weren't even higher. So let's now turn to the second half of the year and what might lie ahead. Now, what I've done here is I've distilled the thoughts and views and projections of a number of advisors that I follow and read, and I've consolidated the common themes here, and then after I've done that, I'll follow with my own thoughts of what that might mean for securities lending. Fundamentally, after more than a decade of globally coordinated interest rate cooperation and fiscal stimulus, what we actually see now are divergences in policy, inflation outlook, growth rates, interest rate policy. So divergence is the watchword for me, and what that also equates to in many cases is also country risk is back. Can central banks walk the tightrope of raising rates to fight inflation without triggering such large economic slowdowns that recession happens? And if there is a recession, some are calling for the US to have a soft landing, but what if it's a hard one? Whereas Europe may be more fragile, with some observers really talking about a recession as a base case. Emerging markets may struggle, but there are many people that are actually looking at China to be a potential emerging market outperformer, even with the zero COVID policy and the related economic impact that it brings. Now, many people are recommending a quality bias for both equities and bonds. They're suggesting reductions in small cap investing, emerging markets generally, and keeping a watchful eye on Europe, which remains somewhat questionable. They recommend a focus on value rather than growth, and this suggests that stock pickers rather than market beta for both the long and short side, and that should be good for the business. For bonds, the target should be investment grade corporate debt as opposed to non-investment grade. I guess there's a sense that bond yields have risen due to concerns over interest rate hikes, but as that kind of levels off, the focus will be on credit quality. So watch for companies that have added debt, or quite a lot of debt in recent years, as their operating costs and costs of capital probably were already higher if they're in the high yield space. They'll get higher still, and their ability to absorb additional costs as part of their operating procedures is less. Of course, those companies are also vulnerable to directional shorts of the equities. Volatility is likely to continue due to the divergences that I talked about earlier. So it's no surprise that I've also read all kinds of recommendations for continued hedging of portfolios and wider diversification and a more tactical, dynamic, and nimble approach to investing over the next year. So specific company situations may force capital raising where they can, and debt restructuring for existing issues as, again, those lower quality companies struggle with rising costs. But what does this all mean for securities lending? Now, volatility is potentially a good thing for lending revenues, But if it's volatile and trending downwards, what happens is returns diminish over time as profits are booked and loan balances decline. So has the market corrected? You can find experts that say yes and no, so I'm not going to give you my less than qualified views on that. If markets fall further, then I think that will be a negative for revenues as balances drop and more positions are closed out. If markets turn around, and it's a volatile trip back upwards, then that could be good. As the policy divergence and rate rises, they create relative value winners and losers. In particular, short positions in many of the companies that are not cash flow positive, and there's a lot of them out there, with tightening monetary conditions increasing the cost of capital, that should present some real opportunities for short sellers in names that have actually done very well in recent years. Now, corporate bond balances and fees should continue to grow. In the period 2015 to 2018, I was trying to build up my own inventory at the bank I worked at of lendable corporate bonds as I expected rates to be rising then and opportunities for lending to pick up. Of course, I didn't expect low, negative, or zero interest rates to continue for this long, and of course I didn't see COVID happening. But I think that's where we're headed now, finally. To an extent, demand for government bonds will pick up as macro traders get back involved, and no doubt there'll be new funds and new opportunities there. I also expect the longer-term trend for HQLA assets for collateral to continue to grow. The next phase of UMR kicks in September, so that will add to demand somewhat as well. There's no reason to expect that M&A activity will pick up, and to the extent it does, it may actually be focused on those sort of more reasonably priced and smaller value transactions for companies that have been knocked back or, again, struggling with the higher costs. So the impact on lending revenue from increased M&A or M&A overall, I think, is going to be negligible the second half of the year, barring any sort of major deals. Many SPACs are running out of time to do deals, so I don't expect the frenzied activity from last year to get a repeat unless we get a miraculous bull run in the face of rising inflation, which would be interesting. So I guess to sum it up, I'd expect lower to flat balances, but potentially good revenues for the second half of the year, with the full year coming in higher than last year. So I hope you found that interesting, but I'm really interested in your thoughts, particularly on this subject as well, because it's all speculative. Put them in the comments or the community page on my channel. That's it for me for this session. I wish you a great weekend, a terrific week ahead, and I look forward to catching you next time.